Welcome to The Interest. I'm Katie Jensen. Today, we'll be telling originators what to expect next on Smashing the Crystal Ball. Then we'll hear some wise words from our own Vincent Valvo in Poetic Moments in Mortgage. And don't forget to stick around for NMP's Mortgage Meteorology report by our own Sarah Wolak. But first, let's take a look at what happened with short-term rentals over the past year. I sat down with private lenders and leaders of private lending associations to discuss what they think about the new restrictions on short-term rentals, which are being implemented in areas across the country. Take a look.
And people who had, they had short-term rentals on the books, they were booked up for the next several months. They had to cancel all that, give the money back.
A few years ago, Airbnb was all the rage. During and after the pandemic, more people began using Airbnb, Vrbo, and other sites to book mini vacations and travel while working remotely. Airbnb investors made a killing, according to Alex Afoot, managing director at Constructive Capital.
Investors were doing it because the economics were really good. Do I want to rent this house out for $2,000 a month, or do I want to rent it out for, $2,200 a night?
Afoot said with that kind of cash flow, investors knew they could offer an amount way over asking price and pay it off quickly. And that's even easier to do when they're using DSCR loans, because eligibility is based on the property's projected cash flow instead of the individual's qualifications. But that creates an issue if the investor needs to sell or convert to long-term renting.
So what you ended up with was this sort of concern that if municipalities were to come in, which is well within their right to do so, and outlaw the practice of short-term rentals, so if you're the capital behind that type of loan, well, that's a big risk.
Fast forward to today, more regions of the country, New York, Dallas, Los Angeles, and other former Airbnb hotspots, are trying to disincentivize short-term rentals with strict restrictions to free up more housing. Those restrictions may crush revenue potential for short-term rentals in those areas, but so does selling or converting to long-term renting.
The value of that real estate can change dramatically based on the operator or the use. So we have seen several people get in trouble where they've been able to borrow more than the property might trade for with a different use.
Velocity Commercial Capital mainly lends on long-term rentals, but CEO Farrar theorizes that many of those short-term rental investors will find a workaround.
A lot of these folks are very entrepreneurial and have figured out very clever ways to maximize revenue out of their real estate. They do what's called an Airbnb arbitrage, and they sign a long-term lease, and then they turn around and do short-term rentals out of it.
The effectiveness of disincentives mainly depends on enforceability. Without it, there will be a booming black market. That's why tens of thousands of New York City short-term rental listings pop up on unregulated platforms like Facebook and Craigslist. According to the COO of National Real Estate Investors Association, that's to be expected.
There's a way to figure out a way around it. Entrepreneurs will do that, and they will. Disincentives are better for bad actors. That if that's what you're trying to address, you can address bad actors with disincentives. If you are trying to disincentivize good business, you have to really wonder what's the real incentive behind the scenes.
Instead, private lenders believe incentivizing investors and homeowners to fix and flip, convert to long-term rentals, or sell is the better way to go.
Instead of looking at investors as the villain, if they looked at them as a part of the solution, and I think we could make some progress in our housing goals.
To read more about what private lenders and association leaders have to say on the Airbnb bust, check out the full story at nationalmortgageprofessional.com. For The Interest, I'm Katie Jensen.
We all dream of owning a home, but for too long, if you didn't fit the mold, you were stuck. Stuck because the system worked for everyone except you. We've changed that. Angel AI uses advanced AI technology to give a 100% trusted solution and fast answers for worry-free financing, allowing you to achieve fair and equal access to lending. Angel AI. AI you can bank on.
For The Interest, I'm LaDonna Lockard. By now, you've probably seen the February jobs report, and as expected, the results were strong, outpacing even economists' projections. 275,000 jobs were added to the U.S. economy last month, but coupled with a report of strong jobs creation, we also saw a rise in unemployment, which hit 3.9%, the highest percentage since January of 2022. Payroll gains slowed in February, and economic indicators are beginning to suggest a slowdown is coming. In the continued fight against inflation, this is good news. The less than good economic news comes with the staggering report on outstanding consumer credit utilization, with the largest increase in 7 months. Outstanding consumer credit tallied up to $19.5 billion. That's billion with a B, nearly doubling the $10 billion estimate from most economists. So although Americans are still spending as though they're flush with cash, their credit card bills are telling another story. This influx in high credit spending may open up the reasoning behind the surprising influx of mortgage refinance applications over the past 2 months, as tapped home equity may provide consolidation for those carrying multiple balances on their revolving and non-revolving lines of credit. Perhaps the refi market wasn't dead after all, but rather was just in hibernation. For The Interest, I'm LaDonna Lockard.
In the world of home loans and finance, when interest rates start to enhance, borrowers all cheer with a hearty, "Oh dear," as their wallets find newfound romance. With rates on the decline, hearts aglow, mortgages becomes easier to tow. The monthly payments shrink as homeowners do think of the extra cash they'll soon stow. The lenders lower their rates with great glee as borrowers dance with sheer glee. Refinancing's the craze in these wonderful days with savings as far as the eye can see. So if you're a homeowner in need of a loan with a lower rate creed, when rates start to fall, you'll stand tall and enthrall as your finances take the lead.
Welcome back to this week's Mortgage Meteorology, where we'll touch on all things to do with the overall climate of the housing market, not just in our neighborhood, but yours too. Starting off, let's take a peek at annual U.S. home price growth, which CoreLogic says heated up gradually during January. U.S. single-family home prices warmed up about 6% year-over-year in January 2024, compared with January 2023. On a month-over-month basis, home prices experienced a light simmer, increasing by 0.1% from December 2023. But CoreLogic predicts that growth is expected to taper off and cool down in the coming months, falling to 2.6% by early 2025. Both higher mortgage rates and inventory shortages are putting pressure on the nation's long-running housing affordability problem. Let's check out some hotspots. Miami posted the highest year-over-year home price increase of the country's 10 highlighted metro areas in January at 10.2%. San Diego saw the next highest gain at 8.5%. Surprisingly, Rhode Island experienced humidity, ranking first for annual home price appreciation in January at over 13%. The Ocean State was followed by New Jersey, which saw prices heat up by 11.6%, and Connecticut up by 11%. No states recorded year-over-year home price losses or cooling, much to consumers' dismay. Meanwhile, as the weather warms up for the spring, the housing market is doing the same. I guess that groundhog was right. Realtor.com says that potential homebuyers will have a wider selection, citing an increase in the number of homes actively for sale, which billowed up to nearly 15%. That marks the 4th consecutive month of annual inventory growth. The inventory of homes actively for sale increased in 29 out of 50 of the largest metros compared to last year. Let's take a look at a couple of areas in Florida that saw homes flood the market the most. Orlando increased almost 40%, Miami about 38%, and Tampa just over 36%. It'll be interesting to keep an eye on the seesaw of inventory and home price appreciation. I'll meet you back here next week with your updated housing market barometer.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.